Welcome back to the podcast, Generate Income by Selling Options. One topic that is important to address in writing options is that of the VIX. Understanding what the VIX is and how it affects option sellers is important. Let's bring in our hosts to dive into the VIX. And as a reminder, please subscribe to this podcast channel in order to stay updated on upcoming episodes. Over to you, Adam and Isla.
Welcome back to the deep dive. Today we are really getting into the weeds on the VIX.
The VIX.
Yeah, and for years it's had this label, the fear indicator, but the sources we looked at, they argue pretty strongly it's too limiting.
It really is. Thinking of it as the unpredictability indicator for the stock market probably gets closer to the truth.
Unpredictability.
Well,
I like that better.
yeah.
So it's not a price itself, right? Like a stock.
No, absolutely not. It's a calculation. It's a measure of implied volatility. And specifically, it's looking at the S&P 500, the SPX, and what the market thinks its movement will be over the next 30 days.
Okay, and how does it gauge that expectation? Where did the number come from?
It's derived directly from option prices on the SPX.
Right.
So if those options are getting really expensive, if traders are rushing to buy protection or maybe betting on some huge swings, then the market is pricing in high implied volatility. And the VIX reflects that it goes up. It measures the expected velocity of movement, not the direction.
Implied volatility. It tends to exaggerate things, doesn't it?
Oh, definitely. It's like an emotional amplifier. It
Yeah.
tends to overshoot reality, both when things seem calm and especially when things get chaotic.
You really see that emotion in how it moves compared to the S&P 500. Usually inverse.
Typically, yeah. Stocks fall, VIX tends to spike. Stocks rally, VIX usually settles down.
And the scale can be just wild. I mean, you look at a relatively calm year, maybe it bounces between, 14 and 26, something like that.
Yeah, that's pretty normal range historically, in quiet times.
But then you get 2008, the financial crisis, and it hits 90.
90 unbelievable levels.
And the sources even mention 1987, Black Monday, pushing 150. That's just pure mathematical panic.
It absolutely is. It shows you just how fast the market's perception can flip from, total complacency to absolute terror.
Okay, so those are the huge headline-grabbing spikes. But our mission today, what we really want to zero in on, is something more subtle. It's this predictable cycle that seems to happen every single month.
Right, regardless of the big picture economic news.
But we're analyzing this tendency linked to options expiration that apparently successful traders are very aware of and will use.
Let's unpack that. So the key event is options expiration day.
Which is always the third Friday of the month.
Always the third Friday. Now, veteran traders, people like Tom Sosnoff mentioned in the material, they've observed this for decades.
And the observation is? What exactly?
It's this. Implied volatility, the VIX, it tends to fade. Or you'll hear traders say it gets crushed.
Meaning it goes down significantly.
Yeah, it drops, often quite dramatically, in the week or maybe 2 weeks leading up to that third Friday. And interestingly, at the same time, you often see the underlying index, the SP 500, get a little bit of a lift, sort of markup.
Okay, a fade in volatility and a rise in the index. Why? Is it just market mood?
The consensus isn't really about mood, it's more mechanical. It seems to be a function of how massive futures and options positions are managed month to month.
The big players rolling their positions.
Exactly. Institutions, market makers, they have these huge, complex books. As that expiration date gets closer, they have to either close out their positions for that month or roll them forward to the next month.
And that process of closing and rolling somehow pushes volatility down.
Well, think about it. As that deadline pressure eases, as all that adjusting and unwinding gets done, the uncertainty premium that was built into those expiring options just sort of evaporates.
Okay. Less uncertainty, lower fee, lower VIX.
Right. Lower volatility signals more comfort, less perceived risk, and that leads directly to the fade. It's like the market taking a collective breath before the final expiration bell.
So it's tied directly to the clock, the expiration calendar.
Very much so. And the data we looked at from an efficiency test covering something like 84 expiration cycles, it really bears this out.
Okay, let's talk timing. If this crush happens before expiration, when does it typically start?
The data points pretty clearly to it, starting about 8 trading days before that expiration Friday.
8 days.
Yep.
So if Friday is day 0, that's like the Wednesday of the week before the expiration week. roughly.
That's right. You could call it W2, the second Wednesday before expiration. That seems to be when the air really starts coming out of the volatility balloon leading into Friday.
Okay, so volatility deflates into expiration. But the story doesn't stop there, right? What happens after the third Friday passes?
Good question. Because once those old options are gone and the new front month options take over, the VIX often does the opposite. It tends to bounce back up.
A post-expiration pop in volatility.
Yeah. Now, historically, looking back further, that bounce often happened around the first Wednesday after expiration, so W+1.
Okay.
But more recent data suggests that timing might have shifted. It seems to be happening faster now, often on the Monday immediately following expiration, M+1.
M+1. That's a significant shift if you're trying to time trades around this.
Absolutely critical detail. Things evolve.
And the sources also highlighted something called triple witching. What's that? And why does it make this whole pattern even stronger?
Right, triple witching. Now, that happens 4 times a year, March, June, September, and December. Quarterly.
Oh,
It's called that because on those specific third Fridays, you don't just have the regular index options expiring. You also have index futures and individual stock options expiring, all on the same day.
wow. So 3 different major types of contracts settling simultaneously. That sounds like triple the pressure.
Pretty much. It magnifies all that rolling and unwinding activity we talked about, and the data shows it. The VIX fade, the pre-expiration crush, it's much more pronounced in those triple witching months.
How much more?
Well, in a normal month, the fade might average around, say, 4%. But during triple witching cycles, that crush can often be more than 10%.
10%. Okay, that strongly suggests the driving force here really is that mechanical pressure
Yeah.
from expiring contracts.
It really reinforces that theory, yes. It's less about sentiment and more about market plumbing, you could say.
All right, so we have this pretty clear tendency baked into the calendar. Volatility fades before expiration, especially doing triple witching, and then it tends to pop back up shortly after. Seems straightforward. So why can't you just build a robot, an automated system, to trade this every month and make guaranteed money?
Yes. The million-dollar question. And this gets to the absolute core of trading versus just observing statistics. It's what experienced traders mean when they say, things work until they don't work.
Meaning these are tendencies, patterns, but not like laws of physics.
Exactly. They are strong tendencies, but they are not guaranteed. And they must be filtered through context. The single most important filter mentioned in our sources is understanding the relative range of the VIX.
Relative range. Okay, let's spend a minute on this because it sounds crucial. What does that mean in practice? How do you apply that filter?
It means you have to be, as they say, reading the tape.
Wow.
You need to look at where the VIX is right now compared to where it's been recently. Is it high or low relative to its own recent behavior?
So not just the absolute number, like VIX at 20, but whether 20 is high or low for the current market environment.
Precisely. Because the tendency for the VIX to fade into expiration, it can fail completely or be really weak if the VIX is already trading at very low levels relative to its recent past.
Can you give an example?
Sure. Let's say for the last 6 months, the VIX has been bouncing around between 18 and, say, 35, a pretty wide range.
Okay.
If it's sitting at maybe 21, well, there's still quite a bit of volatility premium baked in there that can potentially crush down towards 18 or even lower. The fade has room to happen.
Makes sense.
But contrast that. Imagine the market's been super quiet for months. The VIX has been stuck in a narrow channel, maybe between 14 and 18. And now, as you approach expiration week, it's trading at 15.
Right. There's almost nowhere lower for it to go. It's already near the floor of its recent range.
Exactly. You can't fall far off the first step. Trying to bet on a volatility crush when volatility is already extremely low is a losing game. The statistical tendency gets overridden by the simple fact that there's no fear premium left to squeeze out.
So context is king. Check the recent range first.
Always. And there's another factor. Big external events. Huge news items can completely blow up this monthly pattern.
Like what?
Well, think back to periods of major political uncertainty, like the fiscal cliff debates years ago, or maybe an unexpected major central bank announcement is pending right around expiration week.
Okay. Real-world events can override the market's internal plumbing.
Absolutely. If there's genuine, massive uncertainty swirling around because of news, that immediate fear will dominate whatever the usual expiration mechanics might suggest. News trumps the calendar effect.
That actually leads to another interesting point from the data, this warning about low VIX readings. If the VIX stays really low for a long time, signaling complacency, what often happens next?
It often precedes trouble. extreme complacency, where everyone seems convinced the market can only drift higher and risk is minimal. That often sets the stage for a surprise.
A surprise sell-off.
Could be a sell-off or at the very least a sharp jump in volatility right after expiration. If that post-expiration bounce we talked about, the M+1 thing, happens to coincide with a market correction.
Well, that VIX pop can be much larger than usual. A market price for perfection is fragile.
Okay, so understanding the fade, the bounce, the relative range, the news,
Hmm.
how does a trader actually use this? It sounds like you want to be buying options hoping for the fade.
Generally, no. If you're trying to capitalize on this expected drop in volatility, you're usually looking to be a net seller of options.
Selling volatility.
Exactly. Many consistently successful options traders are net sellers over time. They actively look for spots where options seem expensive, where fear is elevated.
Because they expect that fear to subside.
Right. They're trying to profit from two main things working in their favor.
Okay, what's the first? The first is just basic time decay, what options traders call theta. All options lose value as they get closer to expiration, assuming nothing else changes. So just by selling an option and waiting, time is generally on your side. You collect premium as the clock ticks.
Getting paid for waiting.
Essentially, yes. But the second benefit, especially relevant to our discussion, is the potential for that volatility crush, that VIX fade we've been talking about.
So they sell when IV is high, betting it will fall.
Precisely. If some event causes panic and the VIX spikes from, say, 20 up to 30, that's often an opportunity for a volatility seller. They step in, sell options that are now expensive due to that high fee, betting that the 30 VIX level is unsustainable and it will revert back closer to its average.
Mean reversion.
Exactly. Volatility is strongly mean reverting. It doesn't trend up forever or stay low forever. Think of it like a rubber band. You stretch it really far.
It wants to snap back.
It wants to snap back towards its normal state.
Yeah.
The further it gets stretched, the stronger that tendency becomes.
Give me a stock example.
Okay, think of a stock like Apple. Maybe its IV normally hangs around the 25-30 level, but then maybe the stock price takes a sudden sharp dive, say from 700 down to 500 like it did years ago. During that panic, the IV might shoot up towards 35 or 40.
Okay. Much higher than normal.
For the volatility seller, that spike to 40 is a signal. It's an extreme reading. They might sell options then, betting that IV will eventually relax back down towards its more typical 25-30 range, even if the stock price doesn't immediately recover. They're selling the stretched rubber band.
And this is a key advantage of selling volatility, isn't it? You don't have to be perfectly right about the direction of the stock price.
That's a huge edge. You can be directionally neutral or even a bit wrong about where the underlying stock or index is headed and still make money if volatility comes down like you expected.
What kind of strategies benefit most here?
Things like selling strangles, where you're basically betting the market will stay within a defined price range. Or selling naked puts, which is generally a bullish stance, but profits handsomely if the stock stays flat or goes up and volatility falls. These strategies thrive when the VIX is high and potentially ready for that pre-expiration crush.
So the monthly cycle provides a kind of structural tailwind for these sellers.
If they time it right, and crucially, if they pay attention to that relative range filter, context matters most.
Okay, so let's wrap up this deep dive. The big takeaway seems to be: view the VIX less as simple fear and more as a measure of unpredictability. It gives you a detrended look at market expectations.
Right. And that monthly cycle around options expiration, the fade before, the bounce after, is a real statistically observable tendency.
But not a guarantee.
Yeah.
It's exploitable if you apply context, read the tape, check the relative range, and watch out for major news.
Couldn't say it better. Skill comes in applying the tendency, not just knowing it exists.
Now, before we finish, there was one out there finding in the research that we should mention. Something about the moon.
Ah, yes. That was fascinating and definitely falls into the interesting but not directly tradable category. The study stumbled upon a correlation between VIX movements and, get this, the 28-day moon geo-angle relative to a Saturn-Venus composite.
Okay, that sounds like astrology, which we normally wouldn't touch.
And we're not endorsing trading based on planets, but the empirical finding was specific. The cycles that showed the best correlation with VIX behavior were those between 27.4 and 29.5 days long.
Which is pretty much exactly the length of a lunar cycle.
And more importantly, it aligns almost perfectly with the 4 to 5 week structure of the monthly options expiration calendar.
Ah, so the point isn't planets influencing markets, but rather that a cycle of roughly 28 days showing up statistically reinforces how deeply ingrained that monthly options calendar rhythm is in the market's behavior.
That's the interpretation, yes. It suggests the mechanical ebb and flow tied to that 4 or 5 week options cycle is incredibly precise, almost like clockwork, even showing up in correlations with other long-established natural cycles of similar length. It just underscores the non-random predictability driven by the calendar.
Very interesting. It really drives home that the options calendar is the engine here. Something for you, the listener, to perhaps think about next time you see the VIX. Start that familiar fade just before the third Friday of the month.
And that concludes our podcast on the VIX. Thank you, Adam and Isla. If you enjoyed the podcast and found the content helpful, then please like and subscribe to this channel. And if you are on X, then please follow us. Our handle is Selling for Premium. That is the word selling, the number 4, and the word premium. Thanks for listening.